Welcome back to Talk Tickers, your essential shortcut to understanding earnings season. Today, we are deep diving into Edison International, ticker EIX, specifically their Q3 2025 call that happened right at the close on October 28th.
Yeah, and this deep dive, it really has a clear mission, I think. EIX management, they spent this quarter securing, critical regulatory and legislative clarity. The whole aim was to fundamentally de-risk the utility's operational profile. And, well, they executed pretty strongly.
And yet the stocks still slipped the following day. So we really have to unpack that immediate paradox. For utility stocks, there's often this California discount, meaning investors tend to price in that residual regulatory and wildfire risk almost regardless of the positive fundamentals. So our goal here is to try and measure just how deep that discount runs, even after management delivered some major wins.
Okay, let's start with the headline numbers. Because, on paper, they look pretty impressive. EIX reported core non-GAAP EPS of $2.34. That substantially beat the $2.16 consensus CASS. Revenue was also pretty robust at $5.75 billion, also surpassing the $5.31 billion consensus estimate.
Right, a clear beat, but maybe not clear sailing. I immediately noticed management really emphasizing the composition of that $2.34 core EPS number. What was the critical asterisk there? What was the catch?
The asterisk was a large true-up, approximately 55 cents per share. This was related to the final decision on the 2025 general rate case, the GRC, which was applied retroactively back to January 1st. So while this true-up is, real cash, it does mean the number isn't purely operational performance just for the quarter itself.
That makes sense. So the market sees that true-up and maybe thinks, okay, less pure growth here, more of an accounting catch-up. Is that maybe why, despite the beat, the stock actually shed, 1.18% on elevated volume the next day?
Precisely. Yeah, that market reaction, it really suggests investors chose to focus more on the lingering uncertainty rather than, celebrating the financial success of actually securing that GRC retroactivity. It's a classic sign of, persistent skepticism, isn't it?
Okay. So let's look forward then and see how management is trying to overcome that skepticism. They definitely focused heavily on long-term visibility during the call.
They certainly did. First, the FY25 core EPS guidance was narrowed. It's now $5.95 to $6.20. But maybe more important for the long term, they confidently reaffirmed their 5-7% core EPS UGR target running through 2028. And critically, they are sticking with the established $5.84 baseline for calculating that growth.
Okay, so if that $5.84 is their starting point, that 5 to 7% growth target, that's really management putting a stake in the ground, isn't it? Sort of saying, look, we are back to being a dependable utility, not, some speculative gamble.
Exactly. And to back that kind of claim up, they need massive investment, huge amounts.
Right. Let's talk scale then. They're talking about a 4-year capital plan hitting nearly $29 billion. That covers 2025 through 2028. That's huge. So what does that kind of spend actually get them? And maybe more importantly, how are they planning on paying for it without hitting up shareholders for more equity?
Well, that $29 billion plan, it supports a projected 7-8% rate base growth rate. That's really the engine for future earnings. And the critical financing strategy piece here is their expectation to completely avoid common equity issuance throughout that entire 2025-2028 plan horizon. No dilution. That's a major positive for existing shareholders and, frankly, a necessary signal to the rating agencies.
They also mentioned a specific near-term cost to optimize their financial structure. What was the deal with that preferred equity refinancing they mentioned?
Yeah, that was a tactical move. Management basically factored a potential 10 cents per share cost into that narrowed FY25 guidance. It's related to the early refinancing of some holding company preferred equity. Essentially, they're taking a small hit now to lock in better financing cost before major rate resets hit in 2026 and 2027. It's just, smart forward-looking balance sheet management.
Okay, so we've established the financials seem pretty tight, the plan is there, but the real story here, it feels like, is the regulatory environment. Let's pivot to the general rate case, GRC, because that seems to be the linchpin holding up their whole long-term growth plan. What did the final CPUC decision actually deliver for them?
Well, the GRC final decision was excellent for EIX, really good outcome. It authorized $9.7 billion in 2025 base revenue. And crucially, the California Public Utilities Commission, the CPUC, they approved 91% of SCE's requested capital expenditure. That high percentage, it basically validates their whole grid hardening and investment plan for the next few years.
Okay. And that validation brings us to the legacy liabilities, those pre-2020 wildfire claims, which, let's be honest, have been the source of the market's deepest fears for years. We saw some real movement on clearing those up this quarter.
Yes, major progress there. The TKM settlement recovery, that's about $1.6 billion, is now approved, and they're moving towards the securitization phase for that. And then the Woolsey fire settlement, which is targeting about $2 billion in recovery, that's been filed and is just pending CPUC approval. They expect that late 2025 or maybe early 2026.
So, okay, roughly $3.6 billion in liability recovery coming down the pipe. That sounds pretty concrete. Why didn't the market, fully believe it or price it in?
Well, if you look at the numbers, I mean, these settlements, they amount to recovering about 43% of the total costs above their insurance and any FERC recoveries. And the associated securitizations, this is the key part. They're expected to strengthen the FFO to debt metric by up to 90 basis points.
Okay, hold on there. 90 basis points, FFO to debt improvement. For our listeners who maybe aren't knee-deep in utility balance sheets every day, what does that technical improvement actually signal? Like, to Moody's or S&P, why does that number matter so much?
Right. It signals stability and, crucially, the capacity to service their debt. FFO to debt is a primary measure the credit rating agencies use to assess financial health. So improvement of 90 basis points, that's tangible evidence that the utility is reducing its debt load relative to its cash flow. It lowers the perceived risk of, insolvency, and it's exactly the kind of hard number the agencies need to see to potentially upgrade or at least stabilize EIX's rating outlook.
Okay, makes sense. Now let's turn to the legislative tailwinds, specifically that bill, SB 254. This seems like the policy change that could truly alter the risk calculus for future fires.
It really is a material change. Yeah, SB 255 passed with near unanimous support, which is notable in itself. It establishes an up to $18 billion continuation count for the Wildfire Fund. And most critically, it clarifies the liability cap calculation is based on the year of ignition. That provides some necessary financial certainty, or at least a known boundary, for stakeholders moving forward.
And that new policy framework, it was tested almost immediately, wasn't it, with the 2025 Eaton fire? What's the latest status there?
Yeah, timing wasn't great, but the system worked as designed, it seems. The Wildfire Fund Administrator confirmed Eaton as a covered wildfire.
Yeah.
SCE, Edison's utility arm, expects that its equipment will likely be found associated with the ignition, although, investigations are still ongoing. But thanks to SB 254, the established liability cap for that Eaton fire is approximately $4 billion, a known ceiling.
And how does the new law provide liquidity even before there's a final liability judgment? That seems important.
That's the key safety net mechanism, really. SB 254 allows EIX to utilize securitization for 2025 fires, like Eaton, before a final reasonableness review if the initial fund gets exhausted. This provides crucial immediate liquidity to pay claims without having to resort to, say, emergency debt or equity issuance. Management did caution, however, that developing even a low-range estimate for the total potential losses associated with Eaton, that's going to be a long process. So the risk is capped, but the final dollar amount is still, fuzzy.
Right, but it isn't just policy changes. They are actually executing operationally on the ground, right? How is the grid hardening progressing?
Execution is definitely accelerating rapidly. I mean, that's what the GRC funding is paying for. The company has deployed over 6,800 miles of covered conductor cable, and they expect to have hardened nearly 90% of the distribution lines in those high fire threat districts by the end of this year. This is the mandated work, yes, but it's also what drives their rate-based growth and justifies that big capital plan we talked about.
Okay, so this picture we've painted. You've got strong regulatory clarity from the GRC, massive liability containment through the settlements in SB 254, and crucially, no common equity issuance needs. I mean, it all points to a company undergoing a pretty massive shift toward de-risking and improved visibility, doesn't it?
It really does. That's the narrative management is pushing hard.
And we also see EIX positioned to participate in that broader utility sector uplift, driven by AI, data center demand, electrification, the stuff fueling growth everywhere.
Absolutely. They project near-term load growth, SAGR, of up to 3%. And importantly, this isn't reliance on just one silver bullet sector. It's diverse demand. EV adoption makes up about a third of that near-term growth, alongside commercial and industrial expansion. And longer term, they project electricity sales will nearly double over the next 2 decades. The fundamentals are, frankly, screaming growth.
Okay, so given all this positive data, the 5-7% EPS CAGR target, the 7-8% rate-based growth, the, $3.6 billion in liability clarity coming, why the stubborn market skepticism? Why did the stock still slide? What gives?
Well, it really comes down to psychology, I think. That persistent wildfire legislative overhang, especially related to California, it's just deep-seated in investor minds. And the credit rating story is still mixed, which probably amplified that caution. Fitch removed its negative watch, directly citing SB 254 as a meaningful policy shift. That's positive, but S&P actually downgraded EIX by one notch. Management pushed back, arguing S&P's view kind of understates the legislative intent and the concrete de-risking actions they've taken. But until that 90 basis point FFO improvement actually materializes on a paper post-securitization, the market seems content to remain wary.
Right. So for the listener who sees this fundamental disconnect, what are the few key catalysts we really need to watch for? The things that might actually close this gap?
Okay, three key things, I'd say. First, the CPUC final decision on the Woolsey settlement, and then the timing of that subsequent securitization. That's likely late 2025, early 2026. This is the trigger for the material credit metric boost. Second, ongoing updates on the Eaton Fire investigations and the claims process, especially management's timeline for giving even a low-range loss estimate. Need some clarity there. And third, progress on the SB 254 Phase 2 report. That's due in April 2026, and it should hopefully solidify some of the long-term risk allocation reforms.
Excellent. Okay, now we shift gears to our favorite segment, the outrageously plausible trade idea. And remember, everyone, this is strictly for entertainment only, absolutely not financial advice.
All right, let's see what irrationality the market has potentially opened up for us this time.
Okay, the thesis is pretty simple. The market is arguably irrationally pricing EIX based mainly on historical fears, almost completely ignoring the concrete financial benefits, especially that credit quality improvement, that are basically baked in now by the legacy settlement approvals, that little post-call stock drift. I think that's an overreaction.
So you're effectively betting against the persistence of the California discount.
I am, yeah. The pitch is this. Initiate a short-term, long position targeting the imminent Woolsey settlement approval and that guaranteed securitization catalyst that follows. The $2 billion securitization, it's basically a certainty once the CPUC approves it. That will guarantee the substantial, tangible boost to financial metrics. That potential up to 90 basis points FFO to debt improvement we discussed.
Okay, so you're viewing that 90 basis point improvement as the sort of hard evidence, the concrete number that will finally sway the skeptical credit agencies. And by extension, the utility investors who rely so heavily on those ratings.
Precisely. So the trade is buy EIX shares now, betting specifically on that Woolsey approval happening probably within the next, say, 3 to 6 months. View the subsequent credit metric improvement as the real driver that's going to unwind this negative post-earnings sentiment and maybe deliver some alpha before their steady 5-7% growth arc fully kicks in.
Okay, so recapping here, EIX delivered a quarter with strong operational execution, yes, but more importantly, critical regulatory clarity regarding the GRC and major liability mitigation from settlements and SB 254. The fundamental growth story, it seems firm, underpinned by that 5-7% EPS CAGR target and, crucially, zero common equity needs forecasted. But the narrative is still clearly battling the historical optics of that high California policy risk premium.
Yeah, which leaves us with the final provocative thought for you, the listener, to consider. EIX is driving solid 7-8% rate-based growth. It's fueled by massive electrification demands, mandated grid hardening, real stuff. Once that final credit metric improvement from the legacy securitizations actually lands on the books, that 90 basis point bump, will that operational certainty finally be enough to permanently overwhelm and maybe even eliminate the policy risk premium that defines the so-called California discount? That's the billion-dollar disconnect we'll be watching.